welcome on board Manish Sonthalia and find out what he's making of the current market. Manish, hi, morning. Great to have you on the show as always. Manish, you think all that uncertainty and the negative overhang of the Adani saga is now behind us, you think?
I mean, a lot of negative news flows have already got priced in. Whether the worst has been seen or not remains to be seen. But stocks have actually seen a lot of correction. So we'll just wait and watch and see how the whole situation unfolds. So not too much of a call on the Adani group per se is how we'll look at it.
Did you buy in the Adani group of stocks when they fell?
No, we find the valuations a bit iffy, and so we have let go and we have given it a pass.
What has been your portfolio strategy this year? Did you lock some gains in banks? Did you revisited IT? What basically has kept you busy this year?
So I think we are focused on where the earnings growth has been, and I think the earnings growth for India has been coming from three major sectors. It has been the IT names, it has been your banks per se, and it has been automobiles. And what has actually been a detractor to earnings has been oil and gas and metals. So I think the focus is to tilt the portfolio towards an overweight position on these three sectors majorly. And added to that, we think as a contra play, pharma would have seen its worst. And because of a high base of 2020 and 21, you should see decent earnings growth going forward, particularly in Indian pharma company, not so much on the US generic export front, where we still see price erosion. And at the same time, I think capex, particularly government capex, is coming, and private capex should also build it, particularly on the defense, the railways. These sort of areas is where these sectors would remain excited. For us, we think that order book and execution would come through for them.
Manufacturing and capex revival, but some would say that is yesterday's story and yesterday's trend because these stocks have a run up and BP multiples are expensive, whether it's Siemens or ABB.
So, multiples are a function of how the earnings growth trajectory is going to look like, and markets will discount future earnings currently. If the multiples have gone up, I would believe they have not gone up so much that, they would have factored in all of the earnings growth that's likely to come through for them for the next 3 or 5 years. So I think the story still remains intact in spite of the fact that market has taken a realization this is one of the areas which will be in the limelight for the next many years to come. And so I think a tab on the earnings growth per se for the capex will be seen, particularly on the order book and the execution, and the story is yet to be.
Manish, last 18 months markets have given no returns, while the SIPs are strong, touch wood. PMS schemes have also struggled because markets have not gone anywhere. Do you think that could be the talking point for next couple of quarters, couple of weeks now, that investors are now going to be thinking hard that should they stick to a SIP or move to fixed income? Should they stay with a PMS or go to a fixed deposit?
So one thing which has surely changed in the last 1 year or so is the coming back of the fixed income asset class. Particularly when we were in a benign liquidity position, we were in a zero interest rate sort of a regime or very low interest rate sort of a regime. Everybody was focused on either real estate or equities or or gold to some extent because there was a lot of uncertainty. But now, with interest rates rising, portion of asset class allocation would move towards fixed income. There's no taking away from that fact. And given the fact that India has basically outperformed many other emerging markets, the returns have been particularly strong over the last 1.5, 2 years. Earnings growth, we start every year with 20% and then it gets boiled down to 12, 13%. It makes a case for somewhat of a sideways market with an upward bias, definitely. Because once the entire interest rate hike gets priced in, you'll start to see markets also respond very strongly. So from that point of view, I would believe that, yes, flows, particularly the new money coming to equities is finding tough justification from the equity markets near-term return point of view, but long-term trajectory is particularly good. And experienced investors who understand equity markets, have been in equity markets for long periods of time, would know that there could be periods of time correction, but ultimately this is one asset class which gives decent return over the period.
Right. Manish, just wondering that, much like Adani names, and of course, this is not any apple to apple comparison by any means, but the new age tech stocks as well have, gone through that cycle of perhaps bottoming out, and now the news flow is turning better. Wanted to understand how you're approaching the likes of Anika, Paytm, PB Fintech, Zomato, etc.
Some of these names will actually become very big. And given the fact that a lot of them have seen more than 50% sort of a correction, I would believe, and particularly so if you look at our portfolio, we like Paytm as well as Zomato. We think that this habit formation of food delivery is irreversible as far as India is concerned. It's similar to, consumer companies. You get into that habit formation, you like the product, and then it becomes a way of life. So I think when the IPOs came for these companies, it was all about total addressable market, the TAM. Currently, we are going through a phase of the path to profitability. What is the contribution margin? When will the EBITDA be turning positive? So on and so forth. And by the way, these companies today are focusing more on profitability than growth. So you would see that the food delivery business, both Swiggy and Zomato, actually saw some muted growth, but very good contribution margins. And they're on their way to achieve, let's say, 5% EBITDA margins on the food delivery business in some time. So I think ultimately markets will value absolute profits. And, that is how valuations would be derived. At 50,000 crores market cap for a Zomato, I would believe with 10,000 crores plus of cash in their books, yielding at least a 500 crores of other income, the platform has value at that 40,000 crore mark. And I think one got to build in whether 70 crore orders annualized currently would translate into 150 crore orders, let's say 3 years down the line, a 20-25% CAGR growth rate in the number of orders, thanks to a habit formation. And by the way, China delivers some 1,200 crore orders every year. Similar is the case with, let's say, a Paytm, the distribution, business, loan distribution and financial services business is going great guns. Payments business, because of government subvention, is yielding them good money, and EBITDA losses are coming down. So there's no one size fit all for the entire new age tech companies, but there's definite value and in some of them, and some of them will not only survive but grow and thrive and create a lot of.
Hi, morning. What's the outlook when it comes to the entire metal space? Do you think that this could be the pullback year for the metal sector?
No, I don't think so, because if you look at metals is primarily driven by China, and you saw the projection on China's GDP growth for next year. The current year, and at 5%, it was below expectation. So I think metals, on the contrary, could correct very sharply, and the world is battling recessionary trends. So from that point of view, I think metals will be in a bearish trend.
There is a lot of chatter that banks have had their best run up, which is now deposit growth is lacking credit growth. NIMs are not likely to expand. While the sector will do well, the Q3 performance is unlikely, and best of the sector in terms of outperformance is behind us.
No, you are right. The hyper growth in profits that we have seen over the last many quarters, particularly will last for probably one or two more quarters at best. You could see some margin expansion. After that, it's going to be credit growth only slowing down from because interest rates are moving up and cost of deposits, cost of funds is only going to go up, which will be a bearing on margins. And obviously, if you normalize credit cost, these Goldilocks sort of a scenario on credit cost is also not going to be there. So bottom line is that 15 to 20% sort of a growth for large private sector banks, or even let's say a State Bank of India, is achievable. Now it comes down to valuation. There's nothing left on the table as far as the valuation, re-rating possibility is concerned. So what do we do in spite of the fact that absolute profit growth in the sector is here to stay and will only grow over a period of time? Markets would want to look forward to the second, apart from the large 4-5 banks that everybody is tuned on, it comes to the next rung of stock, which is basically your PSU bank. BFSI as a space will remain in the limelight because of absolute profit growth. Of course, in percentage terms, it's going to be lesser than what we have seen in the last 4-5 quarters. But and so it comes down to valuations, and valuations are very full for the large names, and it would be broadly be boiling down to the second rung names, which is your PSU banks, or let's say mid-cap banks. So that's how we would look at it.
All right, Manish, thank you for sharing with us your thoughts on the markets, individual sectors, as well as where you're seeing promise. A quick glance